The Nebius Group has rapidly become one of the most watched companies in the global technology sector. Its stock price surged dramatically after the announcement of a landmark deal with Microsoft, drawing the attention of investors worldwide. This surge was not a speculative blip but the market's response to a structural change in Nebius' future. In this analysis, we'll walk through the company's business model, financial performance, the transformative Microsoft partnership, its growth drivers, risks, valuation, and long-term potential. By the end, it will be clear why Nebius is being hailed as one of the most compelling opportunities in the AI infrastructure market. Nebius is headquartered in Amsterdam and operates research and development hubs across Europe, North America, and Israel. The company specializes in building full-stack infrastructure for the global artificial intelligence industry. Its core business is an AI cloud platform designed for compute-intensive workloads. It integrates proprietary cloud software with in-house hardware to deliver superior performance and cost efficiency. The platform provides everything AI developers need: compute power, storage, managed services, and tools for training and deploying large models. Nebius' specialization allows it to cater to AI native startups, as well as large enterprises requiring flexibility and high performance infrastructure. The company also operates adjacent businesses. Avride, its autonomous driving division, is developing technologies for self-driving cars and delivery robots. Partnerships with Uber, Grubhub, Hyundai, and others demonstrate Avride's commercial potential. Their robo-taxi services is expected later this year in Dallas. Another business, Triple10, is an education technology platform helping individuals transition into careers in tech, particularly in the US. In addition, Nebius maintains strategic minority stakes in AI-related firms. ClickHouse, in which Nebius holds a position, was recently valued at $6 billion, triple its 2022 valuation. It also retains an interest in Toloka, which raised capital from Bezos' expeditions and now operates independently. These stakes not only provide future upside, but also strengthen Nebius' position in broader AI ecosystem. The second quarter of 2025 highlighted Nebius' rapid ascent. Revenue reached $105.1 million, a 625% increase year-on-year and a doubling from the prior quarter. Annualized run rate revenue rose from $249 million in March to $430 million in June, prompting management to increase its full-year forecast to between $900 million and $1.1 billion. Profitability is still evolving but moving in the right direction. The company's AI infrastructure division reported positive adjusted EBITDA ahead of expectations. At the group level, losses narrowed to $29 million from $58.1 million a year earlier. Nebius now expects to turn group-level adjusted EBITDA positive by late 2025, with full profitability anticipated in 2026. Net income for Q2 was $502.5 million, a dramatic turnaround from a $116.9 million loss the year before. However, do note this figure was heavily influenced by revaluation gains on equity investments. Adjusted net income remained negative at $91.5 million, reminding investors that core operations are not yet fully profitable. Operating costs rose by 71% to $216.3 million, with most of the increase tied to research, development, and depreciation. On the investment front, Nebius deployed $510.6 million in capital expenditure during the quarter. This is part of its $2 billion plan for 2025. In the first half alone, it invested $1.05 billion into new infrastructure. The scale of this expansion underscores management's ambition to secure over 1 gigawatt of power capacity by 2026. The real inflection point for Nebius came early this month on September 8, 2025, when it signed a $17.4 billion 5-year agreement with Microsoft. The deal has potential to expand to $19.4 billion if Microsoft exercises additional options. Services will be delivered from Nebius' new flagship data center in Vineland, New Jersey. This center has a total power capacity of 300 megawatts. Microsoft has contracted 200 megawatts of this capacity, with half expected online by year-end 2025 and the rest by 2026. This agreement with Microsoft changes the narrative around Nebius in several ways. First, it validates the company's technology. Until now, Nebius was seen by some as a speculative GPU cloud provider. The Microsoft deal elevates it to the status of an institutionally backed AI infrastructure partner on par with established hyperscale players like CoreWeave. Second, it provides revenue visibility on an unprecedented scale. Annual contributions from the Microsoft deal alone are expected to average around $3.5 billion US, which is multiple times Nebius' projected annual run rate before the deal was signed. This guarantees multi-year growth that investors can quantify with confidence. Third, it transforms the financing equation. Nebius plans to fund the necessary build-outs using cash flows and debt secured against the Microsoft contract. This lowers the cost of capital and reduces reliance on equity dilution, a concern that often plagues rapidly scaling firms. Finally, it boosts customer and investor confidence. A contract of this magnitude not only brings steady revenue but also signals to the broader market that Nebius infrastructure is enterprise grade. It will likely attract additional customers, both startups and large enterprises that want to work with a proven trusted provider. In essence, this deal is more than just revenue. It is validation, financing, positioning, and credibility wrapped into a single transformative event. Nebius' business model is anchored in providing GPU as a service. It leases access to cutting-edge NVIDIA GPUs such as the H100, H200, and Blackwell series. This enables customers to train and deploy artificial intelligence models efficiently. The company's in-house hardware and software architecture deliver cost advantages, estimated at around 20% lower than the traditional alternatives. The platform also extends into related services. Customers can access storage, managed machine learning operations, AI studio tools, and enterprise-grade inference as a service platforms. By going beyond raw CPU rentals, Nebius positions itself as a full-stack provider. This specialization contrasts with the one-size-fits-all offerings of giants like Amazon, Microsoft, and Alphabet. Nebius' tailored approach makes it particularly attractive to AI-native startups and research labs that require maximum performance and flexibility at lower costs. Several powerful factors are driving Nebius' growth. Foremost is the exploding demand for AI compute. Across the globe, companies are competing for GPU access, and even tech giants struggle to meet internal needs. This shortage creates a natural market for specialized infrastructure providers like Nebius. Nebius is responding with aggressive capacity expansion. Its goal is to secure more than 1 gigawatt of power capacity by 2026. This includes expansions in the United States, Finland, the United Kingdom, and Israel, as well as additional greenfield projects under negotiation. With next-generation GPUs such as NVIDIA's Blackwell Ultras expected online soon, Nebius is positioning itself to lead in both scale and technology. Customer acquisition further strengthens the growth story. Large enterprises like Cloudflare, Process, and Shopify have already chosen Nebius for AI workloads. At the same time, AI native startups such as Heijin, Lightning.ai, and Photoroom rely on Nebius infrastructure. Partnerships with ecosystem players include Mistral, Bastion, and Anyscale. These extend the platform's reach, while tight integration with NVIDIA ensures access to the latest GPUs and continued strategic backing. Technology is another driver. Nebius' proprietary cloud architecture and in-house hardware design allow it to achieve superior performance benchmarks. Continuous improvements in the software stack enhance speed, reliability, and flexibility. The development of enterprise-grade inference services further broadens its appeal. Finally, financing capabilities provide Nebius with the means to support this growth. The company has raised more than $4 billion, including the $3.75 billion through convertible notes and equity offerings. Combined with the Microsoft contract, this ensures that Nebius has both the demand and the resources to deliver on its expansion plans. While Nebius' outlook is promising, several risks must be acknowledged. Execution is paramount. The Microsoft deal requires flawless delivery, and any delay in GPU procurement or data center readiness could disrupt revenue recognition. The capital intensity of Nebius business also poses challenges. Billions are required annually for infrastructure, which means profitability will lag revenue growth in the near term. Customer concentration is another concern. Microsoft is set to dominate Nebius' revenue mix for years, and this dependency could be risky if the partnership faces disruptions. The company also trades at lofty valuation multiples with forward price to sales ratios exceeding 27 compared to an industry median closer to 3. This leaves little margin for error if growth slows. Broader market risks must also be considered. A slowdown in AI investments, rising power costs, or macroeconomic headwinds could affect demand. Additionally, Nebius' recent $3.75 billion fundraising introduces dilution that could weigh on short-term share performance. The Microsoft deal triggered a nearly 50% surge in Nebius' stock price, which analysts largely viewed as justified. The rally was fueled not just by the scale of the contract but also by Nebius' scarcity value. As one of the few pure-play AI infrastructure providers available on the public markets, it offers investors an unique vehicle for exposure to the AI compute boom. Investor sentiment has shifted dramatically. Following the deal, D.A. Davidson raised its price target from $75 to $135, while Arete Research lifted its target to $184. Goldman Sachs, which previously had a target of $82, is expected to revise upward as well. However, analysts caution that after such a sharp rally, the stock could consolidate or retrace in the near term. Valuation metrics remain elevated. Nebius trades at forward price to sales ratios of 27 and enterprise value to sales ratios of 26, compared to a sector median of 3. By fiscal year 2026, as revenue scales, these multiples are projected to compress to around 15.6, putting the company on par with Nvidia. By 2028, with revenues expected to reach $5.76 billion, multiples could fall further to 3.9, making the stock structurally cheaper over time. Price targets reflect this duality of high potential and high risk. Conservative estimates put fair value between $114 and $125 per share, suggesting a 20 to 30% upside. More bullish scenarios project values between $300 and $500, and some even suggest levels above $1,000 if Nebius secures additional deals similar to Microsoft's and scales to 1 gigawatt capacity. Nebius has transformed itself from a speculative upstart into a hyperscale AI infrastructure leader. The $17.4 billion Microsoft contract is a watershed moment. This provides revenue visibility, validating the business model and strengthening financing. Combined with its differentiated technology, aggressive expansion, and structural demand tailwinds, Nebius stands out as one of the most exciting opportunities in the AI supercycle. The risks are real. Execution challenges, customer concentration, and high valuation should not be ignored. Short-term volatility is also likely after the stock's sharp surge. Yet for long-term investors seeking exposure to the massive AI infrastructure build-out, Nebius offers a compelling case. With patience, company could prove to be a generational multi-bagger delivering outsized returns as the demand for AI compute continues to grow. In short, Nebius is not just another cloud company. It is a high-growth, high-risk but potentially high-reward investment at the heart of the AI revolution. For those willing to take the long view, Nebius is indeed a buy. Thanks for watching. Have a great day.